Good afternoon, dividend growth stock investors. Happy Friday to you. Congratulations on getting through the 9 to 5 work week. If you are indeed a Monday to Friday 9 to 5er type of a person, you've got Colby here, the DGI Crab, coming to you with my favorite video to record of each and every week. It is about a quarter after 3 o'clock U.S. Central Time. Markets closed just about 15 minutes ago, and we are going to go through each of the stocks in the 4 tiers to figure out where the value lies here at the end of the week, to try to give you some perspective and some strategy going into next week and what to look for. I will preface it all by saying I'm not a licensed professional financial advisor. This strategy and the opinions in this video are just this one crab strategy and opinions. Do your own due diligence before you invest your hard-earned money. All right, so obviously, as you can see here, I'm pretty excited that Nike and SBUX, two of the stocks that I've been buying here on this channel over the course of the last few weeks, have definitely gone on a very impressive rally, which is pretty much to be expected. You know, this channel, if you're new here, focuses on just 60 of the most high quality dividend growth stocks that I could find, and I've separated them out into 4 different categories or tiers based on the age and the time horizon of the investor. So let's take a look at the spreadsheet and see where the value lies. So if it's your first time here, this is the spreadsheet, and this is for the tier 1 investors aged 18 to 30, where the goal is to acquire lower starting yield, but with really aggressive growth rates. You see, we want to get dividend growth rates each and every year of around 12% cumulatively, or hopefully even better than that. And what we'll key in on here is the valuation tab. This is a similar metric that you might see on a site like Simply Safe Dividends, where we are comparing the current day yield to the 4-year average yield to see where we can pick up some value. If we've got something in this green category, it means that we have something that's yielding at least 30% higher than the 4-year average. If it's in the yellow, it's between 20 and 29.9% higher. And in the red is just everything else. So anything in the red, we're just holding on to it. You know, if you've got a position in it, I never recommend selling any of these quality positions. Just sit and let them grow and accumulate, let the dividends reinvest, and enjoy the fact that you've got a position that's taken off and has given you some really quality gains. But what we're really trying to acquire here are the dividends per share. Now, what we've got here is 2 stocks that are in the green category. So Nike, of course, even though it's gone on this rally, it's gone from being in the low to mid 70s. It's jumped all the way back up to 83.26 here at the close of the week. Great news, but in my opinion, when Nike about a month and a half ago was priced around $90, $91, it was still a pretty darn good deal. It's currently yielding 1.78%, meaning every $100 you invest in Nike, you're picking up $1.78 of forward income. Or maybe an easier way to think about that is every share of Nike you buy, you're acquiring $1.48 of annual income per share. This number stays consistent, even though this number jumps up and down all over the place. And what we see here is that even though there's been a rally for Nike, still quite on sale, still the most undervalued stock out of the entire 60 here on the list. But I hope a lot of y'all have been buying Nike along with me in the $73 to $75 range, because we're already seeing major price appreciation on that position. And then Nordson here, if you've been watching the channel and tuning into these Friday videos, you know Nordson's been kind of hanging out in this yellow zone for quite a while, and now they've jumped all the way up to just shy of 40% undervalued. And the reason for that is Nordson just announced a dividend increase. They jumped up from $2.72 per share to $3.12 per share, which represents a 14% increase, right in line with the expectation that I had for what I was hoping that they would do. That's very consistently what they do. It's definitely even better than that 12% that we're trying to get here. So great time, in my opinion, to pick up some Nordson shares, because at 272 prior to the dividend increase, this would have been in that yellow range of 22.04. But now that they've increased the dividend, it's jumped all the way up to 39.9. So what's likely going to happen is the share price is probably going to continue to go up. So the yield will start to normalize with what it's been over the last 4 years. So I think it's a great time to go ahead and add on to Nordson. They increased their dividend exactly like we hoped that they would, aggressively once again. Definitely looking like a good play here. All right, so moving on to Tier 2. This is for the age 31 to 40-year-old investors, my age range that I am in right now. We used to have like 4 or 5 different stocks in the green category here, and now there's only 2 standing. Hershey has that number 1 spot, and Target in second place here, both more than 40% undervalued. Hershey was getting up to that $200 range, and it just couldn't quite maintain, ended up falling back down a little bit, now down back to 193. I'm thrilled to continue adding on to my Hershey position. I think it's a fantastic stock, and I'm very happy to continue to build that one back up. And then SBUX had been as much as 50% undervalued there for a while. And then if you watched my video earlier this week, they brought in the Chipotle CEO to be their new CEO, and that was all it took to make this stock jump from 74 to 94. The dividend per share is $2.28, whether we're getting it for 74 or 94. So hey, if you were adding it in the 70s, congratulations. It's gone on a run, so now it's time to just sit and hold, wait for it to get undervalued again. We've got Hershey and we've got Target here at very attractive prices. Moving on to Tier 3, the 42 to 53-year-old investor. We've got a couple here as well. Hormel and Archer Daniels Midland still continuing to duke it out for the most undervalued stocks in this age range. And both yielding pretty close together, 349 for Hormel, 339 for ADM. 2 excellent companies, and both of them have certainly had their issues this year with their share price. I think that they're both excellent, and certainly think that you're getting a very nice deal here. You're getting average yields in the mid 3s as opposed to the mid 2s where they usually are. So I think these are 2 of the ones on this particular tier that have demonstrated their ability to grow and compound a little bit more year to year than some of the others. Now, the Hormel payout ratio is creeping a little bit high, so we are going to keep an eye on that. But with a 57-year dividend increase streak going, I don't think that they're in any danger of cutting that dividend. We'll just kind of have to wait and see on that. Medtronic, we were buying that one when it was in the high 70s, now up at $84. It's not quite as attractive. Still not a terrible buy if you really wanted to add some, but I'm hitting the pause button on that one myself if I am you guys. Tier 4, age 54 and up for our current income seekers. So again, still just not seeing a ton of value here. It has not been easy shopping here for the 54 and up investors, all 10 of these stocks. And this is the smallest category, you'll notice here. Of the 60 stocks on the channel, there's only 10 of them that were good enough to make the cut here for me. Now, one major adjustment that I made, I did just want to point this out to you, is I've adjusted the dividend per share number for Main Street Capital up to 409. Now, I've had it at 294 up until this week, and then I just reluctantly decided to up it to 409. And just real quickly, I want to explain why I did that. So if you go to Seeking Alpha, go to the Dividends tab on Main Street Capital, you'll see they've got the annual forward payout per share at 409. So why 409 versus 294? Well, the reason is that Main Street Capital has been paying out special dividends, which can be a bit unpredictable. You'll see it's a monthly payer. We've been paying 24.5 cents for several months now. They earlier this year it was 24 cents. They upped it half a cent a month. But then you have these special dividends in here of 30 cents. And they've been doing them these past couple of years on a quarterly basis. Now, I was basing my 4-year average not counting the special dividends, but just looking at the monthly, which is the dependable income that you can count on. The quarterly special dividends, maybe they'll be there in the future, maybe they won't be. Kind of hard to predict that aspect of it. But that being said, Seeking Alpha is taking into account not only the regular dividends, but the special dividends when they're calculating that 4-year average. So it was causing my Main Street Capital valuation number to maybe be a little bit too hard on it. So for now, I'm going to keep it at 409, but at 409 or 294, either way, it's still not a fantastic buy, if you ask me. It's a wonderful company, great monthly payer. Gives you a nice 8.3% yield if you buy it at this particular price. But again, that's factoring in the special dividend, which may or may not occur in the future. Just a quick swing by the top 10 stocks of mine. These are my 10 favorite. If I could only buy 10, any of these 10 stocks, which are smattered throughout tier 1 through 4, if they get into that yellow range at 20% undervalued, I go ahead and grab them anyway. Nothing on here right now fits the bill. So not a whole lot to cover here. We'll talk strategy now. What I do as a dividend growth stock investor, I always recommend it's a smart idea to put half your money at least into ETFs so you have automatic diversification. And you don't have to worry so much about diversification amongst your single stocks because you've automatically got it with at least half your portfolio. For the 18 to 30-year-olds, I think it's a great idea to go 25% S&P 500, 15% small cap, 5% dividend growth, 5% international. These are my favorites of those categories. You can pick your own if you like. And then for the single stocks, I'm going to do probably a 30% and a 20% Nike and Nordson respectively this week. If there's not anything that's 50% or more undervalued, on any of the other tiers, I think you just stay in your own tier, and Nike and Nordson both are excellent buying opportunities. For the tier 2s, I switch it up a little, 25% dividend appreciation, 15% S&P, 5% small cap, 5% international. And for the tier 2s, we're grabbing those 2 green stocks, Target and Hershey, 20% each, and then dipping down and doing 10% into Nike since it is 50% or more undervalued. Next for the tier 3s. So I have this 3-way split here between VYM, SCHD, DHS, which are my 3 favorite dividend focused, higher dividend paying ETFs. You can do whatever percentage between these 3 that you want, or if you've got a favorite, maybe you just do 45% all in one. And then for the single stocks, I'll give a slight edge to Archer Daniels Midland because I think the dividend will grow a little faster there than Hormel. But we've got 25 ADM, 20 Hormel, and then even up here, I'd do a little 5% dip down into Nike. And then finally, for the tier 4, I split that out into 8 ETFs for broad diversification, where you've got high yielding stocks in DHS and SPYD, high yield bonds, preferred shares, MLPs, covered call ETFs, Devo and JEPI, which I think are the 2 best, and still 5% international. And because I don't see any great values in that age tier, I'm just going to say double down on everything up here except for VYMI. We'll keep that international at just 5%, and then you can throw that remaining 5% left over really whatever you want. So, hey, maybe you want to throw something at one of these just because you like them. Maybe with the feds are cutting rates soon, maybe realty income is going to continue to go up. Or maybe you jump down here into the tier 3 and you grab something like Hormel or ADM. Still a respectable yield. Maybe not as much as you'd like, but still solid. So all right, everybody, that's the strategy for the week. Links to the 4 tiers videos in the description below. Let's keep investing. I'll see you all next week.